to you here on Saturday, March 29th. I want to take a few minutes and review yesterday, this little melee that happened in the market here. A couple of reasons why that happened. We'll kind of dissect that here and give you kind of a better understanding. My opinion, they overdid it a little bit here, I think, just because the mindset of a weekend, tariffs on the first, second, whatever, and the way the PC inflation data came in. So take a second with me, and we'll go through and review this. All right, so I like to show you the sectors to kind of get a better understanding of kind of where we are in this little rotation of money. You can see consumer defense held pretty well. This is yesterday only here. They were actually holding better, but as the market continued to kind of unfold lower, even the consumer defense couldn't hold it. You start looking at companies like Campbell's Soup, Pepsi, Coca-Cola, some of the usuals, they even gave way towards the latter part of the day. But the important part is to look at what happened with communication services. Obviously, it was been ticked lower yesterday, but they've been holding up pretty well overall. Technology continues in that rotation of money back out of that tech sector now at around 2.44%. One of the reasons is because it got so high. This has just been such a burner with AI and NVIDIA and super microchip and just AI in general. Some of the computing stocks that are out there, that this may look like that it's a negative thing, but really it's taking some of that just extended, really overpriced tech market off the table, and coupled with a few other things we'll look at here, created this perfect storm for the market to continue to go lower. There are a few things I want you to see towards the end here, statistically, what happened in the market. So hang with me and I'll review that with you so you'll understand better how to trade this market going forward. One thing that caught us by surprise was the continuation after the level standard deviation 2 was broken, almost standard deviation 3. And I'll talk about that in just a second. So stay with me. Anyway, here's the 1 week performance. You can see overall consumer defense, it did pretty well. Gave a little bit back yesterday, but just minute in the grand scheme of things. Here's the big one, though. Technology continues to rotate out. Last week at 3.84. Remember, before it was around 5%. If you look at the overall month here, technology is 7.49% rotation out. Energy has been strong and stayed up and long, obviously as an opposing factor. Usually metals, basic materials usually do fairly well. Metals, the gold index, GDX, and things like that typically oppose the market, along with some of the energy stocks. So this is a pretty good shot that if you look at the Qs, we were around, 2.5% when maybe the SPY was around 1.8%, 1.9 on the drawdown. So you can see the tech sector or the NASDAQ was leading the way in this little Maylab in here. So interesting points. A couple other things when we'll find out is why. Well, yesterday we had PCE inflation numbers. Now, there's no more important number out there than inflation numbers. Well, consumer confidence or the lack thereof can be also very important. But at 8:30 of the core PCE month-over-month index come out here, they were forecasting 0.2%, right, going the other way, right? Previous consensus forecast, and they went this way. So even if you basically land at the same mark and you missed what the consensus of the forecast was, things could go sour on you. But to completely miss that, at least from the way that they draw these numbers out, just put the market in an onslaught. And that started really about 8:30 and really never looked back, almost programmed selling. You could see the way the stair-step into the market came into play there. So interesting points. I want to show you one thing here I'm talking about here. So we're looking here at the SPY here, and we draw our daily standard deviation lines on the high side and the low side. Now you can look at these from a weekly perspective, maybe from the next expiration, the next monthly expiration, but these are a little bit more. And how we get these numbers, you simply go to the short strangle, look at the selling at the money at the close of the previous day, and do selling calls and selling puts. Take that number, and that's pretty much what the expected move is for that day. Now, a lot of people act conservatively and break that down about 80%. But if you use that exact number, this is kind of where we were yesterday. We opened up just slightly below the gap here. And once it made the new high, see how it kind of came back in here, and they got the 2-minute 9 EMA cross, pretty heavy, at a pretty angle crossing VWAP here in the magenta pink color line. And once it kind of took out this low, it really didn't sit back. Got a little bit here at 10 a.m. in the confidence numbers, and boy, it was just an onslaught. this is a huge move right here from 590, 567, just in short order in 20 minutes. You're at what was that, 567? You're at 558, right? So that's a $6-7 move straight off. Here's standard deviation number one, right here, 562.40. We broke through it like it wasn't there. I typically don't do anything until from an extension play. If I'm playing extension, like I'm doing a bull put spread in the same direction the market's going, so I'm looking for where the market may bottom. Now, if you would have played with the early trends on the 1 and 2 minute chart, you would have been successful yesterday, highly successful. But a lot of times these bounce back. I'm not saying they V-bottom in here, but they bounce back. If you look at the Fibonacci yesterday, we had a very shallow bounce all in all. That's the retracement. That's the opposing one. Here we go. If I just take yesterday's open to close and look at the bounce back, well, from here, the bounce back in here barely met 21.6, and that's about where it should. If you bounce 21.6, that actually is that's what you expect to bounce just on short covering, just to get a little bit of a breather in the selling, a little bit of short covering or what have you, people exiting positions, and you get a bounce here. That's not bullish in any way, shape, or form. What's interesting, we came back and nearly double bottom, and then we took back out that high here, and we still came back down. Look what happened at standard deviation 2 line, 557.72. We came down, we toyed off that second one, right? This past the first one, this is the second standard deviation bounce. We try to hold here. And here's the interesting stat right here. I'll bring it up, you can see it better. 95% of the time, there's actually a point something in there. We close above the daily expected move, and that's over the last 20 years of data. Well, probably 25 years since 2000. We have closed above this standard deviation line. Now, as I mentioned in the room yesterday in the Discord, I said, we're at a place here. Well, I said a bounce is cometh, because I expected to be in that 95% percentile. But my further comments in there was, but if we don't bounce, we could close at the low. So the way I look at this and the way I like to describe this is, if you fall out of a 10-story building, or let's say you fall off of a one-step ladder, there's a chance you could get hurt severely, and other chances that you might get back up right away. But if you go up to a 10-story building, you fall out of the 10-story building, you got to look at stocks the same way. They get hurt, and they don't necessarily lift right here. Unless you are just a feathery news down here and the market rallies back in a bullish market, occasionally you do see V-bottoms, either midday starts to make a move higher, or late day starts to make a chuck higher. But yesterday it didn't. We fell out of a 10-story building here, and this market sat there, right? And it was one of those things I said, either we bounce, we're going to bounce here mid to late day, and if we don't, then we have to pretty much be confident that we are going to close at or near the low of the day. And that's exactly what we did. If you look at the daily chart here of the S&P, let me actually bring it up on this blue chart here. I think this is a better picture overall. This is a SPY, by the way. So it wasn't quite as damaging as the Qs, but you can see that's a huge bar on volume in here. See how we closed here? I call this a 10-10 bar. Why? Because 10% of the wick is closed at the bottom. That's negative. That's not even a 21% retracement from a fib level top to bottom. See the 10% now? That means that people that sold here, for the most part, are still confident the market may go lower. For good reason, they're coming into April 1st, April 2nd here on Monday, Tuesday, or by midweek. And if nothing changes tuned in the tariffs, that realization that the lift on the tariff pause isn't going to be there, we absolutely could see break of the low here in the 550 area. So be mindful that that could happen. I'm not saying it will, but if we do bounce up for whatever reason, weekend news, tariff news, what have you, we bounce up anywhere 30% in this bar, because we closed at the low, there are a lot of shorts to cover, which means we could fire this bar back up in there. The less of a tail, the more of a gap, the more of an upward move here, because you're still trapped a lot of shorts who start covering on a rebound, right? Now, I suspect we may hold low here. Maybe we'll go up a little bit here. The key area, though, is the 21.6, 22% in the fib levels. We want to see if we maintain that. Now, we may gap up above it and close below it, but you can kind of get an idea. This is also standard 2. This is a not standard 2, but a level 2 support area at 561. You can see we came through that like butter. But I want to move over to the Qs real quick because this is the one that really got annihilated. You can see we are closer to the bottom on the Qs than the SPY is. Also, look where we turned here. I've been talking about this 200 period moving average, particularly after a huge retracement like that. I mentioned the other day, the best case is back of the 200 period moving average, unless they lift in news and everything goes away on tariffs, and also we could bounce right through that. So there's a look picture of the Qs. Let's go back to the SPY for a second, look at the same thing. Basically did the same thing, went up just above there, so it actually closed above the 200, but very quickly in a spinning top came right back down, so not that much. IWM, obviously, down here, the lows, this have been a lot weaker, and then we'll look at the diamonds. This is the top 30 stocks in the Dow Jones. The diamonds in here, you can see on volume here, pretty heavy move here from around 422 to 415. That's a nice chunk of a move here. Once again, the diamonds or the Dow stocks seem to be up. Why? They're less technology. They're more healthcare. They're more like McDonald's, which has been on a run here until we actually kind of got killed. Great pattern failed. Fantastic pattern failed off of the gap here. And so that just happens. But you got your McDonald's, you got your Home Depots, some of your bigger companies, names like that. They weren't doing that bad overall, right? It was just that the tech, the NASDAQ is where we were just kind of shooting blanks down in here. So there's the big question, or how are we going to work this area here? Let's draw some trend lines here in the NASDAQ just to give you a better picture here. Here's the primary trend line. Actually, I already drew this. I just kind of pulled it back. Here's the primary trend line right down to here, maybe even a little tighter. You can see Fibonacci retracements in here. I went back to about 38.2. They didn't go a nickel over it, right? And again, coupled with a Fibonacci retracement, you got overhead supply. So you got a resistance area, and you got the 200, and you got negative news. That's a recipe for disaster. The market came down hard on volume, as you can see. And then you can see this little bit of a bounce and then a higher low. Now, it did not take off this low here. It was very close. So not enough to really even draw a trend line, right? But something there. And then it gapped back over and took out the high. So it had a chance. It still wasn't out of the woods because of the 200 and where the 38 was. And then all, things with the hell in a handbasket back down in here. Once again, on the SPY, let's take a look at the same trend lines. You can see the primary trend line wasn't quite as bad. And obviously we talked about that because the tech was just getting the worst, the plummet of this, as you saw back in the sector rotation. The secondary line was a little bit worse, right? So the primary line wasn't bad. Very similar. The difference is on the pullback, the SPY actually took out that low, and it did not do it in the tech side. The difference is that the SPY took out the 200 and the tech did not. So again, right in here was a critical area. If you remember one of my previous videos, I drew a line from here, actually a box. I said somewhere between resistance up here, the 50% retracement line, and 38.2 is the danger zone. News could shift us through this. If we get the wrong negative reaction here, we can actually be heading to a fault in here because we're at a critical area. It's go or go home. And obviously they went home. And this is just an onslaught. Now, my opinion, they overdid this a little bit, but I think they did this in light of the rumor news coming out on Monday, Tuesday. If that's going to be in full steam, if he comes out over the weekend and does some sort of a deal or retracement or continuation of Paul's, market's going to bounce substantially off that news in there. So be careful. It's a very difficult time to be long options in there. We make our moves in here, but been playing more bull put credit spreads if I'm doing anything long. We were in McDonald's. We had a great run going in here, and the market got us on the fall. It's not McDonald's, on the fallback. You can see great pattern, double bottom here. You got the 8 cross the 20 period moving average, holding support line, and ignited from the 20. And I talk about this a lot with our team members in our Discord at Full Throttle Traders. So when you ignite from the 20 or ignite from the 8, you want to watch that bar. A lot of times that's algorithmic, and traders get behind that. They look for that. And if you get behind a good algorithm like that, or at least an igniting bar, you have to believe that that pattern's going to work. But because the onslaught happened, the Dow took a big hit yesterday, 730 points down or so, or 713. You are not going to live through that. So that's why you have your stops in place. We took a 15-minute low. And at the end of the day, it didn't matter if you had a 15-minute low or a 30-minute low. You would have got stop loss. So great patterns fail, and sometimes sloppy patterns go forward. That's just it. That's why you have stops. You try to control that the best you can. But so that little bit, even some good patterns in the downturn here, because the Dow hasn't been suspect of that lower moves, we've been able to do pretty well. but we can't hold up against 700 points when the Dow turns on us like that here. All patterns are coming down. It was definitely an onslaught when you take a look at that. If I pull up to just the Dow stocks in general at the end of the day, yesterday, this is the 30 stocks. You can see the only ones that held up here were some of the healthcare stocks, the drug makers. Johnson & Johnson was higher yesterday, right? And it has a decent pattern, still not clearing the 20-period moving average, which is basically the mid of the Bollinger Band. Verizon actually had a pretty good day. Some of the telecom didn't, as you saw in telecommunications. Amazon, one of the worst hit in the Dow, 4.3% down. Nike continues onslaught, and Boeing gave up a little bit here, kind of pressed back here. So a lot of the Dow turned and it just went lower here. And it took some of these bigger names like the American Express, Disney, Caterpillar, and Amazon, and that lifted and that brought a lot of these Dow stocks down with a vengeance. It wasn't hard to kind of see that turn and realize that we couldn't get that bounce off that. So anyway, I hope this helps us to get a little weekend review of what happened in the markets here. On to next week, we'll see what the market's going to do. Remember, Monday, Tuesday, it could be tricky, choppy. Right now, we have been day trading equities, but we've been doing it very tight for the first 30 minutes. And even after that, because the drawdowns in the market and the whippiness of the market, your stocks are just ranging and they're taking you out of the raised stops. And so it's been very difficult to make money in the day trade side unless you just get lucky and catch the bottom, maybe trading some of the pre-market futures in the NASDAQ or these futures in general. You can probably make some money in there. But outside of that, we've been very careful just to get our move and go. And it's even some of the consumer defense stocks are working against it. I'll take one peek at this real quick. And, we actually took a shot here. Consider this is one in the MDLZ. You can see down here, this is the consumer defense stock holding up good in the morning here and actually wedging pretty nice, right? When the market was in an onslaught, we had a nice wedge in here. The issue is we got up here within 1 penny of target here and it came back down and stopped us here. Break even, took your stop out. Either one of those two would have stopped out here and it came back to the end of the day. Look at the backlash here and then the continuation back up to the end of the day. It's just amazing. This was a consumer defense stock, right? So again, this is where we kind of stayed yesterday trying to find that little wedge play breakout. But the market was so weak that even some of your defense stocks just has to give way to the market. So anyway, I hope this review helps. We'll see you in our room at Full Throttle Traders. You can always join for a free trial. Come in there, watch us trade live in and out of these stocks. We trade options, we trade stocks, we trade credit spreads, we trade open range breakouts throughout the day, and pretty active community. So thanks again. You guys have a great weekend. See you next week.